What's going on, everyone? So we have a pretty important update from the Federal Register, and this is involving the National Securities Clearing Corporation's SFT service. And this is a huge filing, so I'm just going to briefly go over this again. The purpose of this rule change is to establish new membership categories and requirements for sponsoring members and sponsored members, whereby existing members would be permitted to sponsor certain institutional firms into membership. Establish a new membership category and requirements for agent clearing members, like Fidelity, whereby existing members would be permitted to submit on behalf of their customers transactions for NSCC novation. This gives Fidelity the ability to do that. Establish the SFT clearing service to make central clearing available at NSCC for SFTs. And lastly, make other amendments and clarifications to the rules. So basically, they filed for this last year, early in 2021. And what SFTs are, they involve the owner of securities, typically a registered investment company, pension plan, sovereign wealth fund, or other institutional firms. So basically all of your share lending vehicles. SFTs are often facilitated and intermediated by broker-dealers and agent lenders. For example, custodial banks or other institutions that lend out securities as agent on behalf of institutions. In return for the lent securities, the borrower transfers collateral, and a net rate payment is typically transferred to either the lender or the borrower that reflects the liquidity of the lent securities, as well as interest on any cash collateral. NSCC understands that SFTs, and this is the important part, NSCC understands that SFTs provide liquidity to markets and facilitates the ability of market participants to make delivery on short sales and thereby avoid failures to deliver, naked shorts, and similar situations. So what is that telling us? What do we know about the reverse repo? It drains liquidity out of the market, right? And it's been doing so at historic levels, never before seen, and it started around April of last year. If we look at this chart here, as you can see, nothing even comes close. So why is this still here? Well, this is our inflation right here, directly tied to inflation. How do you know this? Go look at what's in the repo. You got student loans, bridges, railroads, airports, again, student loans, medical. You got basically everything that taxpayers are paying for. So now we go back to the SFT and we see that the repo takes liquidity out. The Fed is the central clearing. And now we see the SFT where it literally does the opposite. It gives liquidity back to the market and facilitates the ability of market participants to make delivery on short sales. Well, it sounds to me like the NSCC is replacing the Fed for central clearing in these transactions. Now, the two main categories that they're worried about and that they put in here, you have fire sale risk mitigation, which basically, in the case of securities lending transactions, the primary risk of fire sales relates to the reinvestment of cash collateral by institutional firms that are the lenders in securities lending transactions. That would be Fidelity, agent lender. And then the definition of fire sale risk is rapid sales of assets in large amounts that temporarily depress market prices of such assets and create financial instability. So this is going to be what's going to be the worry on the top heavy side, energy, utilities, the shit that's way overbought that needs to come down. This is one end. And on the other end, you have liquidity drain, which is going to be for the lower end of things. So that's capital efficiency, liquidity, right here. Liquidity drain risk mitigation. Their two primary focuses are liquidity risk and fire sale risk. So think about it. On one side, you have the risk of everyone selling off their assets to be able to pay for the delivery on the opposite side. Liquidity risk may also arise if, in the context of a stressed market scenario, borrowers or lenders concerned about their counterparty's creditworthiness seek to unwind their securities lending transactions and obtain the return of their cash collateral or securities. This occurred in 2008 when borrowers began demanding to return borrowed securities in exchange for the cash collateral the borrowers had posted to the lenders. These runs may require institutional firm lenders to quickly sell off securities that are the subject of their cash reinvestments to raise cash to return to the borrower. So fire sale and risk mitigation, two different ways to raise cash to pay off obligations. Now remember, the NSFR ratio that came about in July 4th weekend of last year is literally the whole point of it is to prevent the short-term funding of longer-term obligations. Well, that's exactly what the repo is. So you can see now it's a loophole out of the regulations, and the Fed has got to be replaced, and it's going to be replaced by the NSCC. This is a huge filing. We know now that 21 days from tomorrow, when this is published, we will have either a designation of longer time, an approval, or a disapproval. So let's see what happens. This is the filing that's tied to everything. Inflation, repo, FOMC meetings, everything. So pay attention.